Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for you in light of your financial condition.
Time now for your trending ticker. Tens of thousands of you have been searching for this name on CNBC.com over the past 24 hours, and it is silver. The precious metal has been trading more like a meme stock lately, and sometimes more than the S&P 500 ETF. After rebounding today, it touched a one-month low after a huge sell-off on Friday. It's lost nearly a third of its value since Thursday. It's trying to stay positive right now, around 79 an ounce. Similar story with gold, around 4,700 today after a sharp overnight sell-off. So while both metals have taken some hits recently, our next guest says they're not out for the count. Blue Line Futures Chief Market Strategist Phil Strebel is here to defend that take, Phil. No, I think a lot of people would agree. I even saw a note from JP Morgan over the weekend where their gold team said stay long. So what is the fundamental case for staying long, and what do you make of the recent price action?
Well, I mean, yeah, I don't believe that our days of $100 silver and 5,000 ounce gold are behind us here. I think that this is a market where some of the emotions, they overtook some of the logic here, and you could separate the price action from the fundamentals. Remember, it's never just one thing, it's everything. Look at natural gas, for instance, today down about 25%. So when you get this abnormal return, like what we saw in gold and silver over the past year, silver's up like 265%. A correction will logically follow. I mean, what changed here? The sell-off began with that overnight action in early Asia. You know, the betting market started to price in Trump's new Fed governor pick, the Warsh nomination, maybe eases some of the concerns of Fed independence. Still, you see the yield curve steepening, two interest rate cuts, June and December. It's the exact same as before. The dollar index jumped off a four-year low, so naturally that's going to bounce. And gold is a 15-day inverse correlation, right? 93%. So, you know, gold volatility at 40, this only happened 3 times before, 2011, also the pandemic, and now. The average range, $220 a day here in gold and silver, $10 a day.
But in other words, when I hear those stats, I think to myself, it all got whipped up into a frenzy. And how do I know when that frenzy has subsided? And by the way, a lot of people have been saying, look at the overnight price action. A lot of this was taking place during when Chinese markets were open, for instance, and there was tons of speculative buying happening there. I don't know if you have a comment on that. Regardless, when does it get back to something where I can, or how do I understand what the entry point might be if I'm just trying to use this as a portfolio hedge, for instance?
Okay, I mean, what you want to look at, I mean, if you're going to look specifically at that, you're going to want to take in a lot of different things here. The reason of this pullback here is reasonable. The fundamental underpinnings of the metal, you know, still support a rally in prices. You've got for silver, you've got multi-year supply deficit, booming industrial demand, rising investment demand. And we believe a pullback like this, especially in gold, really provides a tremendous opportunity. With the Basel III reforms, remember that physical gold allocated as a tier 1 asset. That means that many of these banks here, central banks, can count as 100% of its market value towards liquidity for reserves. So it places it where cash and bonds are at. So central banks, they're going to use this opportunity, this pullback here. It logically makes sense. And once the deleveraging is complete, I expect to see a bottoming process form probably this week. The ETF flows, portfolio diversification, the ETF flows continue to maintain positive on the year. We're up 1.6%. So these institutions and retail investors are cementing this as a position of strength in their portfolios. Look at the December lows, 43.17 on gold, on silver 69.25. We start to base out around here and we start to turn up. You're going to see a higher low on the charts, and that's where the retail investor, institutions, central banks come in.
Okay, but on Friday we were told that it was Kevin Warsh and the Fed's pick was the big reason. If you're bullish, that would imply that the move was mechanical or technical, maybe it had something to do with China, Phil, that it wasn't necessarily entirely or partly related to the nominee for Fed chair. Is it?
Oh, there's a possibility. The sell-off began in the Asian markets when the betting markets priced that in, and everyone thought that Warsh is this very hawkish participant. But when you look at things that are done, the yield curve's still steepening. The dollar index is bouncing just a bit. Nothing dramatic. It's still in a bearish trend here. We're coming off of 4-year lows. I can remember, I'm old enough to remember 3 days ago, gold at all-time highs, silver at all-time highs, and dollar at 4-year lows. So these markets don't change that dramatically in a day. Volatility does take that with $10 moves and $220 moves in the gold market in a day. But once this froth comes out of the market and you get the algos, the FOMO traders leaving this market again, things will normalize, and then those fundamentals will set their place back in. And I believe that gold will continue to march on, and the same thing with silver. How many people were chasing at $120 to go out and buy physical? $75? This looks like a bargain to me at these levels.
You better hide that, Phil. That was that.
No, it was $1,000 last week. It's only $750 today.
Phil, thanks very much.
Thanks.
Phil Strebel.
Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for you in light of your financial condition. All information, communications, publications, and reports, including this specific material used and distributed by Blue Line Futures LLC, shall be construed as or in the nature of a solicitation for entering into a futures transaction. Blue Line Futures LLC does not employ research analysts or maintain a research department as defined in CFTC Regulation 1.71.